That is an important commentary coming in, given the fact that in India, the retail fuel prices, that is petrol and diesel prices, continue to remain unchanged since May 2022. Now, we are excluding here the VAT and the excise duty changes that the government has done so far. If you remove that, then the petrol and diesel prices are largely unchanged here. Now, in May 2022, crude prices were at around $110 per barrel level, and currently they are at $70 barrel. So that's a $40 drop that we have seen. But despite that, fuel prices continue to remain at a higher level. Now, why is this? Because oil marketing companies' margins have increased drastically. At current prices of around $70 per barrel level, they might be earning around 13 rupees per litre on both petrol and diesel, which is at a multi-quarter high for all the oil marketing companies, that is Indian Oil Corporation, BPCL and HPCL. So that could be cut, and that would lower, or that could gradually reduce the profitability of the marketing segment for these oil marketing companies. Now, to discuss that more in detail, we have Harshvardhan Dole, Vice President of IIFL Securities, who tracks the oil and gas space very closely, joining us on the show. To start off with, sir, firstly, given the fact that crude prices have come down drastically and OMCs are earning a significantly higher marketing margins now, do you think that they might have recovered or recouped all the losses that they had incurred earlier, and they are currently even recouping the losses that they are incurring in the LPG segment currently?
So good afternoon, and thanks for having me on the show. So while the oil prices are down, and there is a general impression that oil marketing companies are making reasonable but unreasonable amount of money in terms of selling petrol and diesel. However, people are forgetting the fact that the gross refinery margins or the product cracks have also collapsed. So while people are focusing on the marketing side of the business, the refining side of the business is not making great amount of money. For example, the Singapore refinery margin, last I checked, had crashed down to just about 2 or $1 per barrel. So if you net out the expenditure, they are not even breaking even basis the benchmark margin. So I think people need to take a holistic view rather than just looking at focusing on the marketing side of the business. So I think if you evaluate the integrated margins, they should be making reasonable money, if not abnormally high money, abnormally high amount of money after the oil prices which have corrected. On the
Estimate where?
LPG front,
Okay.
I think the LPG prices on a sequential basis have either gone up or firmed up. And to that extent, the LPG losses still continue to incur in the hands of oil marketing companies. And the way we see things, by selling per kg of domestic cylinder or LPG, these companies are losing nearly about 12 to 13 rupees in terms of per kg. On per cylinder basis, one would have to multiply that number by 14 and a half to arrive at aggregate number. So just don't focus on one side of the business, which is rosy. There is challenge on the other side as well.
As you were mentioning that there are challenges on the other side, but the picture that is at least looking rosy, on that side, what could be the integrated margins that the oil marketing companies would now be getting by selling the retail fuels as per your estimate?
So if I were to look at on a petrol, the margins are in double digits. Diesel on the spot basis, margin are on double digit basis. However, these are spot margins. And for drawing the quarterly P&L, one would have to look at the YTD as well as QTD margins, which for diesel are just about, a rupee and a half. And for petrol, these are like, 3 to 4 rupees per liter on a quarterly basis. So if you were to look at quarter, things will be reasonably okay, if not abnormally high for these companies.
So now if we consider the entire business, be it, that is refining and the marketing segment combined, then do you think that oil marketing companies would have some margin to reduce the fuel prices?
So in my opinion, one should not look at these numbers on as-is basis. One would have to look at how the volatility in the oil prices is likely to emerge. If one believes that for a reasonable period in time, oil will remain below 60, then basis that call, there is a room to cut the petrol and diesel prices. However, I prefer to be conservative. I'm still working with an oil price for the year, which will be in northwards of $70. And therefore, scope to cut product prices remains reasonably low, if not very high.
And when it comes to now oil explorers like ONGC, like within a matter of like 15-20 days, things have changed and narrative have completely changed for them. From being one of the top preferred pick in the oil and gas space, given the fact that crude prices were stable, they were also earning when it comes to gas prices also in the domestic market. But now, given the sharp fall in crude prices, how are you looking at ONGC as an investment pick right now? Would you suggest investors to still hold on to ONGC given the fact that we have seen a sharp drop in crude prices?
So our published numbers assume Brent at 75, and that's how we have arrived at a consol EPS of around 41 rupees. With every $5 change in oil prices, consol EPS will drop by about 7 to 8%. And to that extent, if Brent were to average at say $70, then on a consol basis, ONGC will report an EPS which is anywhere between 35 and 38 rupees. So at the current price, the valuations are very attractive as compared to other integrated regional players in the region. And to that extent, ONGC offers us a very good trade-off in terms of higher upside versus lower downside. And we continue to like, in general, the PSUs in the sector, including ONGC.
Okay, Harsh, on that note, we'll let you go. Appreciate you making time and speaking with us today. But let me now.
If you like this video, then like, share and subscribe to ET Now.